Hello and good evening, everyone. Today's webinar topic is Global Investment, MFS, LRS, and GIFT Gift City Pros and Cons. So, for this, we have with us Mr. Neil Borate, heads the personal finance team at the Finprint, a financial content platform. He is a graduate in laws and economics and has also passed the CFA level exam. Neil started writing about personal finance in 2016 at Value Research, a mutual fund research portal. After a stint at a fintech, Neil joined Mint in 2019 as a mutual fund reporter. He was made deputy editor in 2022 and editor, especially in personal finance, in 2024. He has also co-authored the book The Big Bull of Dalal Street on Rakesh Jhunjhunwala, one of India's most successful investors. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels, aimed at enhancing the quality standards in securities markets. Now, before beginning the session, I would like to request all the participants to note some important points. That first, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. And third, that is the recording of this session will be available on NISM YouTube channel. Now I request Neil sir to begin with this session.
Hi, everyone, and thank you for joining the session today. I will keep my presentation as brief as possible so that you guys get the most amount of time to ask questions. This topic is possibly the most important topic in capital markets today, given the global and Indian situation also. So without further ado, I'm going to begin the presentation. All right. The the reason why this is such a burning topic is because most of us as Indians tend to invest the vast majority of our portfolios in India, and of course, India is a rapidly growing economy, and the stock market returns also have been extremely good. But this is home bias. It results in a huge amount of country risk that we all take. And that is why it's important to understand how to diversify ourselves into other markets also. So, in case some of you have seen that WhatsApp forward about 1 rupees equals $1 in 1947, and then how the rupee depreciated to 88, 89 rupees. Now, this tells you the actual history. So, contrary to the WhatsApp forward, the rupee was actually 3.31 rupees to the dollar in 1947-48, and it has over time fallen steadily to reach its present level. So here's a quiz question for you guys at the start. Which year was the worst year for depreciation of the Indian rupee against the dollar? If you guys can type that in the chat, I'm going to give you guys 1 minute to think about it. Which year was the worst year for the Indian rupee against the dollar? 2020, 24, 25. Nope, nope. 95, 955, 6. Nope. 92, good guess, but no. 2013, good guess, but no. 91, again, good guess because of the 91 reforms and the currency crisis, but no, the answer is none of those. Oh, I think somebody got it up in the yep. Sarthak Jain has got the answer. So the answer is 1966, and the reason is the Indo-Pak War. Um, and in that year, the rupee had an astonishing 56% depreciation. It lost half of its value against the US dollar. The rupee back then was a controlled currency completely, unlike today, where it's what you might call a managed float. But the broader point is that in a single currency, we are at a great deal of risk of constantly losing value, purchasing power against other currencies, and that hurts our consumption both in terms of imported goods and also foreign consumption. So our tourism, our education abroad, various reasons to spend money outside India. All right, moving on to the next. Yeah, so here's a photo of the Times of India from that time. The Times, by the way, has got the percent wrong. It's not 36.5, it's 56%. They have just calculated it on the wrong denominator, but the broader point remains the rupee lost a huge amount of its value in that year. Now, this is my favorite chart when it comes to global diversification. It makes that case beautifully. I can't think of a better chart. And this is compiled by UBS. They do a study every year. Now, what does this chart tell you? I want you to begin with me from the year 1900. You will find that the country which has the largest share of the global stock market, right? If you think of the whole world stock market as one pie, the country which has the largest share of it is GBR, Great Britain, in 1900, which is 24%. Now, follow the trajectory of Great Britain from that time, and you will notice that there is a gradual decline, a gradual contraction, all the way until the present when it reaches some 3-4%. So, anyone who invested only at that time in British stocks would have just seen a century more of relative decline, not absolute, but relative decline. Um, the big red splosh on your screen is the United States of America, and the US begins at 15% of the global market cap. It rises steadily all the way to the 1980s, and at that point, it has a bit of a dip. That dip is because Japan sees a sudden surge in its market share because the Japanese stock market had a huge, almost bubble situation. And then you see Japan also contracting from the 1980s onwards. India, by the way, you might ask in all of this, where is India? The answer is India is too small to even be present on this map. And it tells you the importance of being spread out rather than being completely in a global small cap. Now, how do you invest? So I'm assuming that the case for investing globally has been established. So let me take a minute to talk about how do you actually invest abroad. Um, Now, one option and the simplest option is the mutual fund industry, and it's very very simple. A global feeder fund operates just like any normal mutual fund. It's denominated in Indian rupees, even though it invests abroad. It has a NAV which is declared every day. It has very clear tax rules. Below less than 2 years is slab rate. More than 2 years is 12.5%. But unfortunately, since 2022, fresh flows from mutual funds have been stopped by the RBI. So that leaves only LRS as your option. And within LRS, there are some variants. Before I proceed to those variants, here's another quiz question for you. Can you guess the fund? Yes. So as most of you are correctly answering, this is the Motilal Oswal Nasdaq Fund. So the return since then is a. Now I'm going to give you another example and ask you to guess. So here's another example of an international fund. Can you guys guess the fund in the comments? Yes, as many of you are correctly guessing, this is the HSBC Brazil Fund, and it is almost the converse of Motilal Oswal Nasdaq. It's given a CAGR of minus 1.85%. So the reason I'm highlighting both of these funds is because global diversification comes in both directions. You can get it right and you can get it wrong. Now, what if you didn't know back in 2011 when both these funds were launched, which would do well, which would not? What if you had just done an equal amount of investment in both, right? 5 lakhs in both. How would you have done? So the answer is that your 5 lakh in the NASDAQ would have been 90 lakhs today. Your 5 lakhs in the Brazil fund would have been 4 lakhs today. And cumulatively, your 10 lakhs would have been 94, which is a CAGR of 17%. The Nifty CAGR by contrast is 12%. The small cap CAGR by contrast is 20%. But very few people invest entirely in small cap. So even a balanced portfolio of half Nifty, half small cap would be 16, and that's slightly lower than a mixed portfolio of US and Brazil. I'm trying to compare like for like here, apples for apples. If you had gone blind into global diversification and blind into domestic, where you've done half Nifty, half small cap, the returns are quite similar. The benefit here is global is not correlated to domestic. So in years in which domestic does badly, like the past year, global tends to do well, and it just smoothens out your experience. This is part of the same UBS study. The ultimate test of whether something is actually working in finance is uh, whether it's improving your Sharpe ratio. And the professors who did this study found that in almost all cases, it does improve the Sharpe ratio. If you had been, let's say, a French investor or an Irish one, your Sharpe ratio would be positive by diversifying outside the home market. And that includes India. India is somewhere in the middle of this chart. Now, as I said, there are many routes. So the simplest one is a feeder fund, but they've been blocked since 2022. The second one is directly through a brokerage abroad. Some of them also are present in India, like Interactive Brokers. The third option is through a fintech, which is tied with a broker abroad. So fintech like Vested Finance or InMoney. And the fourth and emerging option is Gift City in Gujarat. I won't repeat this. So as all of you know, feeder funds have hit that cap of 7 billion. There are some which are still open because essentially SEBI allows funds which have seen redemption to reopen for that amount. Think of it like a local train that or a bus. Somebody gets off, it creates some space, so you're able to get in, but only for that duration. These funds tend to again close when they get full. Then there are some funds which have a mix of Indian and foreign stocks. So think of a Parag Parikh FlexiCap, for example. These funds do not close, but what happens is they cannot deploy fresh money outside. So when money flows into them, they see a dilution, a smaller and smaller percentage of their corpus is invested in foreign equities. So Parag Parikh, for example, has gone from 35% overseas to about 10% at present. The second option is investing through brokers. So as I said, Interactive Brokers has a presence in India, and you can invest up to $2.5 lakh every year. But above $10,000, you will face a TCS of 20%, tax collected at source. This is just a collection of taxes, not a fresh tax. So you can adjust it against your tax liability, or you can claim a refund in your income tax return. The third option is to invest through a fintech like Vested Finance or InMoney, and they have tie-ups with brokers abroad. So it's quite similar to option two. The only difference is that because they're catering to Indian customers, they are optimized for Indians. So they provide ready-made reports for your tax reporting for Schedule FA, and they're compliant with Indian rules and foreign exchange. So it's a slightly easier route. And finally, there is Give City, which is a rapidly emerging option. So Give City already has a number of AIFs, which invest globally. Minimum ticket size over there is $1.5 lakh. So it's out of reach for many, many Indians. There is a hack to it. If you are an accredited investor, then you can invest as little as $10,000. To prove that you are accredited, you do need to meet certain criteria like having a net worth above 1 million US dollars. Then there are retail funds, and this is probably the fastest emerging option for Indians, and eventually might become the default option. So the first such fund by DSP has been launched in Gift City in June 25, minimum $5,000 of investment. It invests in markets around the world, US, Europe, Japan, South Korea, Canada, for example. The tax is a bit different from what we are used to. So any churn that the fund does in the first 2 years, the fund pays a tax of 42%, which is very steep. So they try to minimize the churn in that period. After 2 years, it's 12.5% on par with domestic stocks. This is an infographic that we did about this particular fund. It's just the first, remember. There will be many more launched into many different kinds of markets and strategies. So to keep a watch on this space. So with that, happy to take your questions. You can type them in the comments, and we'll try and unmute some of you to actually ask them, but we can begin with the comments. All right, feel free to type your questions in the comments and I'll take them up one by one. So somebody has said Mirai also has a presence in Gift City. Yes. So there are AIFs, there are multiple other AIFs than Gift City. The reason I've mentioned DSP in particular is because they are the first and only retail fund, which is a $5,000 ticket size. All right. Second question is 40% tax on gift retail. Yes, because they are categorized as trusts and they are subject to the highest marginal tax rate. But that's only if they do some churn, which is buying and selling in a 2-year time period. If they do it after 2 years, then it's 12 and a half. So I'm sure they'll try to minimize that churn. On the infographics, so I'm happy to share the presentation after this call and you can see it at your leisure. It's also part of a Mint article, so it's there online. Currency angle. So, in terms of currency, all of these are equally good because they're all investing ultimately in the same uh, underlying currency, which is the dollar or the euro, whatever that fund strategy is. And the tax angle, which one scores best overall? Probably the domestic funds, the traditional mutual funds, which are onshore because it's easy to understand, easy to comply with. But that route is stopped by RBI. So probably the second best option is Gift City from a tax point of view. What kind of funds launched in Gift City? Are those lump sum based only? Eventually, SIPs will begin. Right now, yes, you can say they're lump sum because the cost of transferring small amounts of money abroad is quite prohibitive, the Forex charges. Are the global access providers a good option to internet? So these are essentially platforms in which you can use Gift City to eventually invest abroad, but they're not really adding much. So I'm there's no particular advantage to the global access providers in Gift City. In detail. So right now there's only one Gift City fund, which is DSP, as I mentioned. There's a video that I've done, by the way, with DSP on it. If you just YouTube the fine print, you can find my video with detailed chat with the DSP fund manager on their strategy. There are no other funds yet which are retail and outbound, so I can't give you more details on other funds yet. Indian fintechs, yes, as I said, Vested Finance, Zinc Money, Int Money, they're all fintechs which facilitate global investing. Mohit asks, how much foreign exposure? A good number is, I would say 30%. No, the scientific approach actually should be in relation to India's market cap, which means that ideally India should be weighted at 5 or 6% only. But since we live here and we are more familiar with this market, probably 30% overseas makes sense. How to get associated to sell these funds? So the mutual fund in the question does the onboarding. So in case of DSP, if you approach them, they will get you onboarded as a distributor. What is a desirable route which is cost effective? So gift cities will eventually get more and more cost effective. Right now, the only maybe two pain points are the forex charges when you invest there and the expense ratio. Expense ratio, if you do direct plans or if you do higher ticket sizes, that the fund houses are allowed to offer a lower expense ratio. It's a it's a new concept for us because we don't have different share classes, but Gift City allows it. So for higher ticket sizes, they do reduce the expense ratio. Uh, what is the procedure for SIF? So SIF is a different topic, a different subject, and entirely we can do a separate webinar on it. But I don't want to mix that here. Where can we get more information about the retail DSP fund? If you Google DSP IFSC, IFSC is International Financial Services Authority. If you Google that, you should find their website or you can find their Twitter handle also, and you can get more information. Um, More on Gift City retail. Can we also buy individual stocks? like vested or ETFs. So if you want to buy individual stocks or ETFs, probably a fintech is a better bet for you because Gift City is more about funds. Using that to invest in stocks right now is not a viable option. The National Stock Exchange does has a subsidiary which has some what are called unsponsored depository receipts there, but they are very low volume, so it's not really worth going there for that. US tax implications. So yes, above $60,000, if you pass away, then the US does levy an estate tax. The best way to counter that is to invest through what are called UCITS funds, UCITS. They are Europe domiciled and they're not affected by US estate tax. Similarly, gift city funds will not be because it's not been allowed by the government. So that proposal has not taken off. uh, Pros and cons of investing via Gift City. So the many pros are that um, it's Indian institutions and which are familiar with as an Indian regulator, IFSCA, which is governing it. The tax is compliance is easier because it's inside India for income tax purposes. The only Sorry, I think my connection got lost. Just to summarize the pros, it's Indian institutions like AMCs are regulated in India. There's an Indian regulator, which is IFSCA. So you have the comfort of that. And tax compliance is easier because GIFT City is considered to be inside India for income tax purposes. So there's no need for Schedule FA and the other tax compliance which comes with overseas investing. Uh, the only con or downside is that right now there are very few funds, so you don't have much choice. But I think that'll get remedied in maybe a few months or or a couple of years max. Um, Indians can invest only with a net worth of $1 million. No, that is if you want to become an accredited investor. You don't have to be. That just allows you to put a lower amount of $10,000. So that's an optional thing. And NRIs is a different thing. So Gift City also has inbound funds where NRIs can invest. They are completely separate. They invest in India, not outside. And for only for those you have to be an NRI. Otherwise, as a resident, you can invest in what are called outbound funds. They're investing in other markets from India or other from Gift. Explain the LRS in detail. So you can take out up to $2.5 lakh a year for various purposes, education, investing, and so on. The 20% that TCS can be offset with your advance tax, or you can claim a refund for it. There are certain things that you cannot do by LRS. You can't do leverage trading, but by and large, you can invest in any kind of stocks or bonds or funds that catch your fancy. Um, would you be able to deal a credit investor above 1 million? What benefits? The main benefit is that the ticket size comes down. You can put in $10,000 into AIFs. Um, and it has nothing to do with being an NRA. It's completely separate. You can be a very much a resident and be a accredited investor. Can we invest in European markets through Western money? Yes, yes, you can. I believe so. Western is a US broker, so maybe they will have ETFs which invest in the US in the European market. So, for example, if you want to invest in the stocks 50 ETF in the stocks 50 index in Europe, there is an ETF with ticker FEZ. You can, or there are many ETFs. It's just an example of how you can invest in Europe as well. When DSP are getting launched, it's already technically launched. So in Gift City, there's a 6 month time period for NFO. So that's why it seems quite long, but it's already launched and you can invest even as we speak. Industry representation for 7 billion. I think they've been trying for a long time, but that's not being changed. Fintechs like InMoney and Zinc are cost effective. You can compare the costs between fintechs and choose the one which has the lowest costs. But yes, many of them are competing with each other, so they would have brought down the cost. Motilal Oswal Nasdaq has stopped accepting. Yes, because the industry limit has been hit. So it's not just them; it's across the board. Can I open an FD account in Gift City? No, not for too long, or rather, you can't at all because there's an RBI rule that if you have idle funds, they have to be brought back within 180 days or 6 months. So you can't do an FD in Gift City, but you can invest in bonds or bond ETFs if you want fixed income. How much retail investor starts? Well, that's up to you, but right now the minimum amount is $5,000 in DSP. Other AMCs might bring it down further. What is a reasonable expense ratio to pay for since well, that is up to you again. Right now the expense ratios are quite similar to onshore. So DSP I think has 2.5 lakh, sorry, 2.5% cap. I don't know the exact amount. I'll have to double check, but it's quite similar to um onshore funds, and direct plans are cheaper. That might go to 1.5%. HDFC has come out a demat account. Um, they haven't publicized it much, so I can't comment on that right now. Any smart. So I don't believe in themes like AI, biotech, etc. I believe in broad-based global investing. But if you have a particular view on AI, there are many ETFs which track AI, biotech, etc. So we'll be releasing some videos on other funds. So there's an Ionic Wealth fund also in Gift where they are doing some of these themes. So stay tuned for that. I'll be releasing videos on it with those fund managers. How big is the market domestic? Yes, so currently it's quite small, but eventually, as India grows wealthier and people diversify more, it will rise quite a bit. Commission structure, I think, is quite similar to domestic, so you can negotiate it, but I think a 1% commission is very, very doable. Maybe going too far, but looking at the current, um, well, geopolitics is not predictable. So what the US government will do is not in our hands, but it's not in their interest to act against uh, the investment that they are getting. So I don't think the US government will act unfavorably against Indians investing in the US. um, अगर आपको समझ में नहीं आ रहा, अगर मैं ज्यादा इंग्लिश में बात कर रहा हूँ तो आप बता दीजिए, मैं हिंदी में बात करता हूँ. Next, advantages of investing. So I started with the slide on currency. The main benefit is that the dollar tends to appreciate against the rupee. The other benefit is that Indian markets have become expensive over the past couple of years. So by investing in cheaper stocks, cheaper ETFs, you can get a higher return. If NRI doesn't have Aadhaar, can they invest? Yes, they can. Right now, the inbound funds have a largely physical process. So you have to give proof of identity, proof of address, get it tested um, by a local notary or by a bank branch, and then invest in an inbound AIF. So the best way to do it is by contacting the AMC in question. To what extent is Vanguard FTSE All World a diversity tool? It's yeah. I mean, a global ETF can automatically diversify you across without without too much of an expense ratio of an active fund. Can you explain the asset allocation of DSP Global Fund? So please look at my video. It's on YouTube. If you just Google the fine print, I'll just type it here. Sorry, the fine print YouTube channel. You will find my interview with the DSP, with Jay Kothari of DSP in a lot of detail. So I encourage you to look at it. Um, Preference for the first time investors, stocks for or mutual funds, definitely mutual funds, because picking stocks needs a lot of research, needs a lot of study. Most of us don't have the expertise. Most of us don't have um, the bandwidth to figure out which stocks are going to do better. So funds or ETFs are a much better way. ओके, कुछ लोगों को का कहना है मैं हिंदी में बात करूं, तो ठीक है, आगे क्वेश्चंस में हिंदी में आंसर करता हूं. पर्सपेक्टिव ऑन गिफ्ट सिटी इन्वेस्टमेंट्स फॉर एनआरआईज. तो एनआरआईज के लिए गिफ्ट सिटी एक बहुत ही अच्छा माध्यम है, क्योंकि वहां पे कोई टैक्स नहीं लगता अगर आप इन्वेस्ट करना चाहते हो इंडिया में. और अगर आप ट्रेडिशनल रूट से आ गए तो आपको हर कैपिटल गेन पे टीडीएस भरना पड़ता है. काफी कम्बरसम होता है, और आपको अकाउंट भी चेंज करने होते हैं. Okay, so some people prefer that I speak in English. I think, stick to English for now. And whoever prefers Hindi can maybe send some feedback and we'll do a separate session in Hindi. So, okay, Give City for NRI of Indians, both. So there are inbound funds for NRIs which invest in India and outbound funds for Indians who want to invest outside India. It's as simple as that. It exists for both categories of people.
Hi, I'm
Hi,
Manish.
Manish, please go ahead.
Okay. So, Neil, investing in Gift City in funds like DSP Global Fund for a retail customer, it is a bit of complicated matter. Is there any way where, I mean, is there any flow or a flow chart or any video that you have done which we can look at and try investing it there as a retail customer?
The video, yes. If you go to the YouTube channel of Fine Print, I've discussed with Jay Kothari on their philosophy. On the process, unfortunately, we haven't covered in the video, but that's good feedback for me. I will work with my colleagues and create that flowchart.
So Neil, I've watched that video a couple of times, and the intent was to actually understand how do I start from scratch as a retail investor. But that video basically tells about the strategy and the tax, obviously, which is important, but it does not guide a retail customer as to how he starts. Like, what does he do with the bank? How does he kind of creates that money which has to be transferred to the gift city, whose account it
Yeah,
goes? I mean, from the scratch. How
agreed,
do I
agreed.
start on a day one?
Duly noted, Manish. We will get onto that and we will create that.
Thank you, sir.
So next I'm unmuting Samir Mahajan. Hi, Samir.
Hi, Neil. Thanks. My understanding is if I invest in global through vested or in money in stocks, it comes under the umbrella of US estate tax implication. But if I do that through the upcoming retail fund or AIF, it will not come under that umbrella. Is my understanding correct?
Yes, it is. If you go through Gift City, then it will not come under that umbrella.
Okay, so vested is still liable for the US
Yes,
through
because there
West.
your stocks, yes, because there your stocks and ETFs are held in the US. But of course, that applies above $60,000. So if it's a lower amount, then not an issue.
Okay, thanks.
Next up we have Arun Sundar. Yeah. Hi, Arun. Hello.
Hi, Nick. Good evening. I raised this question in the chat box. We couldn't find any more information about the DSP city apart from your video.
Yeah. No, I will speak to them and try to create the flowchart that was mentioned earlier and also maybe bring them back in for a detailed video on the process of it. They're also, it's the first time, it's the first fund there, and for them also it's new. So I don't think they have been able to give enough clarity. But I think they have their own, I've seen their X handle on DSP IFSC, and they might have a website also. So that might have some more information, but yes, I will get back on those points.
Next we have Priyam. Yeah, Priyam Saxena. Hello.
हेलो
Yes, you're audible, Priyam.
सर मेरा ये क्वेश्चन था कि जैसे अपन म्यूचुअल फंड वगैरह के बारे में तो नॉलेज है मेरे को बट मेरे को ये पूछना था कि ग्लोबल इन्वेस्टमेंट के लिए ईटीएफ कौन से सही रहेंगे
तो प्रियम, मुझे स्पेसिफिक ईटीएफ्स का कि अगर आप डाइवर्सिफाइड ईटीएफ्स को यूज करते हो तो आपकी रिस्क कम हो जाती है। मतलब इंस्टेड ऑफ ए पर्टिकुलर थीम, अगर आपने बायोटेक या एआई चूज किया तो वो एक फोकस्ड बेट होता है, या फिर अगेंस्ट दैट आपने एक डाइवर्सिफाइड ईटीएफ किया जो बहुत सारे कंट्रीज और मार्केट्स को ट्रैक करता है, तो आपकी रिस्क तो कम हो जाती है।
Next is Chetan Raman. Hi, Chetan. Hello.
Yeah. Hi, Neil. Can you hear me?
Hi Chetan, yes, I can hear you.
Yeah. My question is for the resident Indians, can they open USD savings account in the gift city and subsequently open brokerage account with any of the international brokers like Charles Schwab or Robin Hood and use this gift city US denominated account as a funding account?
So answer is theoretically yes, but practically speaking, because of the RBI rule of 180 days that any unutilized funds had to be brought back, banks are not advertising this. They are not pushing. They are not, launching this in a big way. So I would expect maybe in a year or so, some fintechs might come up in partnership with banks that will offer this. So there's something called the PSP license, Payment Service Provider license in Gift City, where fintechs can become the front end for banks and offer these accounts. So already there's a fintech called Belong, which offers this for NRIs. They have a US dollar tie-up with RBL, and their pitch is that the interest rate is higher in Gift City compared to US. But so far, nobody has done it for resident Indians. I expect in the next maybe 6 months, 1 year, there will be solutions.
Okay, but in terms of funding account, what I mean is obviously within that 15 to 20 days, we transfer the funds for investments into, say, money market ETFs. But tomorrow, if there are any redemptions or inward remittances we want to do, we sell that ETF and then subsequently get back money. From the operational point of view, there is no regulatory restrictions per se.
There is no restriction, no.
All right, thank you.
So next up we have Gopal Krishnan Gupta.
Hi, am I audible?
Yes, you are audible.
Much
Yes.
appreciated and thanks for this video. It is an eye opener for some of the guys.
Thank you.
Madhav, I am a returned NRI from Dubai. Okay. While I come back, I kept my US dollar funds in my UAE account only. Okay. The question for me is, when you said investing in a gift city, can I invest from my UAE dollar fund?
Yes, you can. There's no restriction.
Okay. And the second follow-up question for this is, when I invest in any mutual funds and all those things, the returns also they will give to the same bank account in dollar?
Yes.
Okay. Then
Yes. Sorry, go ahead.
how the tax implications will happen?
So, any gains that you make for a less than 2 year holding period, so let's assume that you have invested in a stock for simplicity. Any gains that you make in a less than 2 year period will be at slab rate, more than 2 years, 12.5%. Same for ETFs, same for funds. DSP is a bit of a special case because they are taxed at fund level. So you as the investor, you don't pay tax, but the NAV that you get if you redeem in 2 years is net of that 42% tax. So the idea is not to redeem in for 2 years at least.
Okay. Instead of 1 year capital gain, it is 2 years.
2 years. 2 years. Yes.
Okay. Thank you.
Next we have Gauri Shankar N. I have muted Gauri Shankar. Hello, Gauri Shankar.
Okay, there may be some difficulty unmuting. Shall we go to the next person?
Okay, we will move to the next. Yeah, so next up we have Chandrasekhar Kadam. Yeah, Chandrasekhar, hello.
Yeah, am I audible?
Hello, sir. நான் ஹரணியோட ஃபாதர் பேசுறேன். நீங்க கூட்டிட்டு வரீங்களா சார் இன்னைக்கு ஹரணிய? ஆமா சார்.
Somebody is unmuted.
Yeah, I think
Sahil, can you
mute.
அவர் பேர் என்ன சார்? அவங்களே வந்துருவாங்கல்ல சார்? சரி.
Sahil, can you unmute this individual, please?
சரிங்க சார். சரிங்க சார். Thank
Yeah,
One second. We'll just make sure. Okay. Yeah, Chandrasekhar, you can go ahead. Yeah.
Okay. So my question is, let's say NRIs, right? They have, for example, they have if NRI exposure to India markets, they have option of MSCI India ETF, right, which is listed in US in dollar denominated in the India market. So what specific advantage is to invest through Gift City, take India market exposure? Because just now you said, right, even the NRIs will be taxed at par with others, or after 2 years, or they have to hold it 2 years, etc. What advantages for NRIs to invest through Gift City?
Okay, so the existing US ETFs and many other funds are registered as FPIs in India. So when they make gains, India deducts tax on them, on those gains. And so you'll find that the NAV of those funds tends to lag the actual return of the Indian market. If you take the two largest US listed ETFs tracking India, which is INDA and INDY, one is based on the MSCI, the other is tracking the Nifty. You will find that the return is lower than the actual return of the market, even converting to US dollars because of the tax issue. So what Gift City does is it allows a tax-free access to Indian market. It's not on par with residents because India does not tax NRIs who are coming to the Gift City, which are investing in mutual funds, not in stocks, but in mutual funds. So a couple of days ago, we put out an infographic on different AIFs which are feeding into specific mutual funds. For example, HDFC has some AIFs feeding into specific HDFC funds like FlexiCap. Then there are some fund houses which feed into a basket of their own funds. There are some AIFs which feed into multiple AMC's funds, like Edelweiss has launched their AIF. So all of those routes are tax-free for NRIs.
So if I understand correctly, if the NRI invest in mutual funds through Gift City, then they are not taxed. However, if they invest in stocks, they will have to hold 2 years, and I mean, otherwise they will be taxed at the slab rate, right?
Yeah, so think of Gift City like a pipeline. If the pipeline feeds into mutual funds, there is no tax. If the pipeline, which is an AIF, right, that structure is an AIF, if that feeds into stocks, then yes, there is taxation.
Thank you.
Now, one last person who has raised their hand, that is Koshi Oman. Hello.
Yeah. Hello. Can you hear me?
Yes, yes, we can hear you.
Yeah. Yeah. Hi, Neil. First of all, thanks for organizing this session. I think it's quite useful. I just want to know from an NRI perspective, when there are obviously different options, you can go instead of Gift City, you can go through other options. But I'm a little more interested in the Gift City route to understand how NRIs can benefit by investing through the Gift City instead of investing through any other route out. And especially, I'm more also interested in understanding funds which are investing into markets other than India. Because in the India market, I can invest directly through the NRE or NRO route in Indian rupees. But I think when it comes to the currency depreciation, which is obviously a big concern, what is the best way to hedge that?
Okay, so I'll answer the second question first, which is investing outside India, the global route. There, you may not be currently at a big advantage to go through GIFT because those outbound funds are meant for residents. And why should you suffer that taxation, which is which applies to residents, especially if you live in the Middle East or some more favorable jurisdiction. When it comes to investing in India, it is definitely an advantage to go through GIFT for two reasons. One is the complications that come with the onshore route. We have to figure out NRE, NRO, PIS, non-PIS. Then remitting the money back is also a big pain, especially if you're doing it through NRO. There is TDS. Every time you make a gain, the mutual fund in question has to deduct TDS, or the broker in question has to deduct TDS. It is a lot of paperwork and very, very annoying. In GIFT, all of that goes away. So you just directly remit money in dollars to the GIFT City fund, and the GIFT City fund in turn feeds into an Indian mutual fund. And when you redeem, there is no tax on you either in India onshore or in GIFT. The only tax that applies to you is in your home jurisdiction.
So just on that, sorry, if you have existing SIPs already going on in Indian rupees, then would it make sense to stop that and then do directly through Gift City then?
Yes, right now there are only AIFs, so that's a minimum ticket size of $1.5 lakh. So if you don't want to deal with that kind of ticket size, the first retail fund is being launched. The first retail inbound fund is being launched in a week's time, and I'm sure many will follow suit. So if you just give it maybe 4 or 5 months, you will have a decent amount of choice in terms of retail inbound funds, and at that point you can look to switch some of your SIPs through that route. But do remember, SIPs currently would be going through, I mean, unless you're bringing in the money from your foreign earnings, if it's just Indian money you're investing in India, then it may not make too much sense to then move it to gift. This concept, this idea applies to fresh foreign earnings that you might have otherwise brought in through the traditional onshore route.
So any money in the NRE, whether lying in mutual funds or in the NRE account, will not make sense, is it?
I mean, it's an additional hop. So then you will have to first
Right.
take out that money from India,
Yeah.
convert it to dollars, and then invest again in dollars into gift. So it's a bit of a hassle.
Yeah. Right. Understand. And I think the first part, what was it? I think it was...
Yeah, on global. So if you want non-India exposure, there are plenty of good options in Europe and US. You don't have to go through gift.
Right.
At least right now, the way it's built, it is built for residency outside the outbound part.
Right. Understood. Thank you.
Thanks.
So there are a few more people who has raised their hands. Yeah,
Yeah,
I'm
we have
looking
about
now.
7 minutes left, so last maybe 2 or 3
Yeah,
questions.
yeah. Next up we have Arakshit Bajaj. Hello. Yeah.
Hello,
Yes, you are audible, Arakshit.
sir. My question is here that what is the difference between the special economic zone or the gift city? Are they same SEZ and gift city, or is there any difference?
Yes, Gift City is an SEZ, so there is a 10-year tax holiday for funds which are located in Gift City. For investors, it does not make that much difference because we are still being taxed. But if you intend to set up a business in Gift City, then you do enjoy a 10-year tax holiday. So it is favorable. So it is a kind of SEZ, it's dedicated to finance specifically. SEZs can be about manufacturing, they can be about particular sectors, pharma, etc., etc. This particular SEZ is about finance.
Yeah, Samir, you are able.
Yeah, hi, thanks. So, one quick question. So, I used to work in US and I have dollar denominated funds outside, which have been like accounts has been declared in my foreign assets. So, if I'm moving those funds and want to invest into Gift City, is it required for me to convert that from USD to an INR and then again INR to USD through Gift City, or can I fund the Gift City directly from my US bank account?
You can fund Gift City directly through your US bank account. There's no need to convert to INR at all.
So that is the case in even, for example, DSP retail. If I have to invest, that is not a problem. Like without a bank account
Yes,
in
it
Gift
is.
City, I can
Yes,
do that. Okay, thank you.
correct. You don't need a bank account.
Chandrasekhar, you can ask your question.
Okay, I was having a follow-up question that you mentioned that there will be retail fund that will be launched in a week's time, which will not be subject to that $1.5 lakh ticket size. So can you tell us the name, etc., about that fund? I mean, if you can tell something more about it.
So as a journalist, I can't give away breaking news before we break it. But
Okay.
it's a couple of days that we will announce that. So it is an inbound retail fund, by the way. So outbound already DSP has done it. This will be the first inbound retail fund.
Okay, and that also, but otherwise, right now, except that fund, otherwise, the there will be 1.5 lakh ticket size, right? Dollars ticket size for NRIs to invest.
Yes, already there are many AIFs which have that $1.5 lakh ticket size, and they are offering inbound investment. But retail so far, in fact, two are coming up. So I'll announce that in just a few days.
Okay, okay. 1.5 lakh and this I mean, the new funds are obviously getting launched, but there is nothing available below $1.5 lakh currently, right?
At this precise moment, no, but just give it literally maybe 4 days and news will be out.
Yeah, thank you.
I think so. We can take one last person. That is Sohan. Yeah, Sohan.
Yeah, hi Neil. Good evening.
Hi, Sohan.
Hi. Neil, I just wanted to ask about FIF fund. Uh, there was lot of news about the same, but the news faded away since last 1 year. So, can you throw any light on what happened to that?
Yeah, so FIF was supposed to be a vehicle for large Indian family, wealthy Indian families to invest overseas, much higher than the LRS limit of $2.5 lakh. Um, that unfortunately RBI is not comfortable with, so they have not allowed FIFs to proceed. There is another option called OPI, Overseas Portfolio Investment, for wealthy families who own companies, because then the investment can be routed through the company and up to 50% of the net worth can be invested overseas. So OPI is something that we will shortly write about, but OPI is very much allowed and flourishing.
Understood. So, this firm will have to have an NBFC license to invest abroad.
No, they're not related to each other. The NBFC, the deemed NBFC requirement kicks in if more than 50% of revenue comes from investing activities. As long as that much is ensured, that you don't hit that cap, that should not be an issue.
Understood. Thank you so much. Yeah.
Thank you.
Yeah. Thank you so much, sir. I would like to extend our heartfelt thanks for taking time and speaking at the webinar. Your insight, expertise, and presentation as well really made a lasting impact on the audience. Yeah. Thank you again, sir, for your time and knowledge.